Gold just shattered all records, and what it's telling us about 2026 will shock you. Right now, as you watch this video, gold prices have exploded past $5,100 per ounce, an all-time high that no one saw coming this fast. Silver just crossed $112 per ounce for the first time in history. Platinum is breaking records. And while mainstream media tries to downplay what's happening, the world's wealthiest investors are screaming one message loud and clear: get out of the danger zone. This isn't just another market rally. This is a full-blown panic, and it's revealing cracks in the global financial system that governments desperately want to hide. From Trump's 100% tariff threats that could trigger a North American trade war, to looming recession signals that veteran investors say feel exactly like 1999, the warning signs are everywhere. By the end of this video, you'll understand why 75% of investors fear a market crash in 2026, and more importantly, what the gold rush is telling us about the economic storm that's about to hit. Let's dive in. Act 1. The record-breaking surge. 0.45 toucher 4.30. The numbers that changed everything. On January 26, 2026, financial markets witnessed something extraordinary. Gold prices didn't just climb. They exploded past $5,100 per ounce, shattering every previous record in history. And this wasn't a slow, steady rise. This was a frantic stampede as investors around the world abandoned traditional assets and fled to safety. But here's what makes this truly unprecedented. It's not just gold. Silver surged to $112.18 per ounce, a record that seemed impossible just months ago. Platinum hit all-time highs. Even palladium is rallying. The entire precious metals complex is on fire, and Wall Street analysts are now predicting gold could hit $6,000 per ounce before the end of 2026. Goldman Sachs just revised their December 2026 forecast upward to $5,400 per ounce, and even they admit this might be conservative. Morgan Stanley, JPMorgan, and Deutsche Bank are all sounding the alarm. When the world's biggest investment banks start competing to predict how high gold will go, you know something fundamental has broken in the global economy. What safe haven demand really means. Let me explain what safe haven demand actually means, because this is critical. When investors buy gold, they're not betting that gold will make them rich. They're betting that everything else is about to get much, much worse. Gold doesn't pay dividends. It doesn't generate income. It just sits there. So when trillions of dollars flood into an asset that generates zero returns, it means one thing: investors have lost confidence in stocks, bonds, real estate, and even the currency itself. They're not trying to get richer. They're trying to survive what's coming. And right now, the velocity of money flowing into precious metals is unlike anything we've seen since the 2008 financial crisis. Except this time, it's happening when stock markets are near all-time highs, unemployment is relatively low, and central banks are cutting interest rates. On paper, everything looks fine. But the smart money is running for the exits. The central bank buying spree you're not hearing about. Here's something the financial media barely mentions. Central banks around the world have been quietly hoarding gold at unprecedented rates. China, Russia, Turkey, India, all of them are accumulating massive gold reserves while publicly claiming their economies are strong. Why would central banks, the institutions that print money, be stockpiling gold unless they know something we don't? Because they see what's coming. They understand that when confidence in fiat currencies collapses, gold is the only asset that can't be printed into oblivion. The People's Bank of China has been buying gold every single month for over 2 years. Russia has been building reserves despite crippling sanctions. Even countries like Poland and Singapore are dramatically increasing their gold holdings. This isn't a coincidence. This is preparation for a monetary system reset that's already underway. Act 2. Trump's tariff bombshell, 438.45. The 100% threat that triggered market chaos. On January 24, 2026, President Donald Trump issued a threat that sent shockwaves through global markets. He would impose 100% tariffs on all imports from Canada if they proceeded with a pending trade deal with China. Let that sink in. 100%. That means every single product crossing the Canadian border into the United States would double in price overnight. Lumber, oil, natural gas, automobiles, food products, everything would become instantly twice as expensive. This isn't just about punishing Canada. This is about rewriting the rules of global trade in real time, and the markets are terrified of what comes next. Because if Trump is willing to threaten America's closest ally with economic annihilation, what's stopping him from doing the same to Mexico, Europe, or any other trading partner? The economic domino effect. Here's why this matters more than you think. Canada is America's largest trading partner, with over $750 billion in annual trade. Implementing 100% tariffs wouldn't just hurt Canada. It would devastate American consumers and businesses overnight. Gasoline prices would skyrocket as Canadian oil imports grind to a halt. Home construction would collapse as lumber costs double. Automotive manufacturing would face supply chain meltdowns as parts from Canada become economically unviable. This single policy decision could trigger the recession that Wall Street veterans are predicting. And here's the really scary part. Trump has already walked back tariff threats on 8 countries, suggesting this might be a negotiating tactic. But the damage is done. Markets now know that 100% tariffs are on the table, and that uncertainty alone is enough to drive investors into gold and other safe havens. Why gold responds to trade war fears. Trade wars are inherently deflationary and inflationary at the same time, a toxic combination economists call stagflation. Here's how it works. Tariffs raise consumer prices, inflation, but they also destroy international trade and slow economic growth, deflation. You get the worst of both worlds. Gold thrives in this environment because it's the ultimate hedge against policy uncertainty. Investors don't know whether to prepare for runaway inflation or economic depression, so they buy gold, which protects against both scenarios. And with Trump's tariff threats creating chaos across multiple continents, gold becomes the only rational choice for wealth preservation. Bloomberg reported that investors turned from risk assets to traditional safe haven assets immediately after Trump's tariff threat, with gold and silver surging to fresh records within hours. The Swiss franc rallied. Japanese yen strengthened. Every major safe haven currency and commodity moved in unison, a clear sign that global investors are preparing for economic war. Act 3. The recession warnings no one's talking about. 845-13. When billionaires start sounding like doomsday preppers, Paul Tudor Jones, one of the most successful investors in history, just said that 2026 feels exactly like 1999. For those too young to remember, 1999 was the year before the dot-com bubble exploded and wiped out trillions in wealth. And Jones isn't the only billionaire sounding the alarm. Bank of America just issued a warning that investors are dangerously unprepared for a stock market correction in 2026. Evercore ISI predicts a 15% drop. Morgan Stanley warns of a 10% correction this quarter. Deutsche Bank has joined the growing list of pessimists. When Wall Street's biggest institutions start competing to predict how bad the crash will be, you know we're in trouble. But here's what really caught my attention. A new survey found that 75% of investors fear a market crash in 2026. 3/4. When was the last time you saw investor sentiment this negative while stocks were still near record highs? It doesn't happen often, and when it does, it usually means the smart money is already positioned for the worst. The recession indicators. Flashing red. JPMorgan's global research team just put the probability of a U.S. and global recession at 35% for 2026. That might not sound high, but consider this. That's the highest recession probability JPMorgan has assigned since 2022, when the Federal Reserve was aggressively raising interest rates to combat inflation. The yield curve, the most reliable recession predictor for the past 50 years, inverted in July 2022 and stayed negative for nearly 2 years. That's the longest inversion since 1978. And historically, when the yield curve finally uninverts, a recession follows within 12 to 18 months. We're right in that window now. The Conference Board's leading economic index has been declining for months. The SOM Rule recession indicator shows the 3-month moving average of unemployment rising by dangerous levels. Consumer confidence is weakening despite strong headline employment numbers. All the classic warning signs are there, yet mainstream media keeps insisting everything is fine. The market correction everyone sees coming. Here's something you need to understand. Market corrections are inevitable. They happen, on average, about once every 18 months. What makes 2026 different is that everyone knows it's coming, yet no one wants to be the first to sell. This creates what's called a crowded exit problem. Imagine a theater where everyone knows there's a fire, but the doors are too small for everyone to leave at once. That's the stock market right now. Valuations are stretched to historic extremes. The S&P 500 is trading at price-to-earnings ratios last seen during the dot-com bubble. AI stocks have created another speculative mania reminiscent of 1999, and yet investors keep buying, driven by FOMO, fear of missing out. They know the crash is coming, but they don't want to exit too early and miss the final rally. This is exactly how bubbles end. Not with a surprise crash, but with a predicted crash that everyone sees coming but no one can time correctly. Gold hitting $5,100 is the market's way of saying, the exit doors are starting to close. Get out while you still can. Act 4. The Geopolitical Powder Keg, 13-16. Why Iran, Russia, and China matter to your portfolio. Gold doesn't surge past $5,100 just because of tariffs or recession fears. It surges because the entire geopolitical order is fracturing in real time, and investors know that when empires collide, paper assets become worthless. Iran's economy is in freefall, with protests erupting across the country and the currency losing 84% of its value in 2025. Food prices have jumped 72%. The regime is on the brink of collapse, yet Iran still has nuclear ambitions and proxy forces throughout the Middle East. When desperate regimes face internal collapse, they often lash out externally. That's a recipe for regional war. Russia's economy is barely surviving under the weight of sanctions and war costs. The IMF just slashed Russia's 2026 growth forecast to 0.8%, essentially stagnation. Oil revenues are down 25%, yet Putin shows no signs of ending the Ukraine war. A cornered authoritarian with nuclear weapons is one of the most dangerous forces on Earth. And then there's China. The world's second-largest economy is facing a real estate crisis that makes 2008 look tame by comparison. Property prices are plummeting. Banks are stuck with foreclosed properties they can't sell even at 50% discounts, and 70% of Chinese household wealth is tied up in real estate. When that bubble finally pops, and it will pop, the global economic shockwaves will be catastrophic. The de-dollarization movement. Accelerating. Here's the trend that terrifies Western financial institutions more than anything. De-dollarization. For 80 years, the US dollar has been the world's reserve currency, but that dominance is crumbling faster than anyone predicted. China and Saudi Arabia are conducting oil trades in yuan. Russia and India are settling payments in rubles and rupees. Brazil and Argentina are discussing a common currency. The BRICS nations, representing nearly half the world's population, are actively working to reduce dollar dependence. And what do all these countries have in common? They're all buying gold, because gold is the only truly neutral reserve asset. It's not controlled by any government. It can't be sanctioned. It can't be frozen in Western banks. As the dollar's dominance fades, gold becomes the ultimate store of value in a multipolar world. When gold hits $5,100, it's not just a price. It's a vote of no confidence in the entire post-World War II financial system. And that vote is coming from central banks, sovereign wealth funds, and billionaire investors who see what's coming before the general public does. Act 5. What this means for you. 16 to 1830. The investment implications you can't ignore. So what do you do with this information? First, understand that gold hitting $5,100 is not the end of the rally. It's likely just the beginning. Goldman Sachs predicts $5,400 by December 2026. Other analysts are eyeing $6,000 or even higher if geopolitical tensions escalate. But this isn't investment advice. I'm just reporting what the smartest investors in the world are doing. They're diversifying into hard assets. They're reducing exposure to overvalued stocks. They're building cash positions to take advantage of the coming correction. And they're accumulating gold, silver, and other precious metals as insurance against systemic risk. Here's what history teaches us. In every major economic crisis, whether it's 1929, 1971, 2008, or 2020, those who positioned before the crash not only survived but thrived. The investors who suffer the most are the ones who refuse to believe anything could go wrong right up until the moment it does. The 3 scenarios for 2026. Let me outline 3 possible scenarios for the rest of 2026, ranked from most to least likely. Scenario 1. Controlled correction, 60% probability. Markets experience a 10 to 20% correction, recession fears prove overblown, and the economy enters a soft landing. Gold consolidates around $5,500 as safe haven demand moderates. This is the optimistic scenario, but even here, gold remains elevated because trust in traditional assets has been permanently damaged. Scenario 2. Recession and stagflation, 30% probability. Trade wars escalate, a recession hits, and inflation remains sticky, creating stagflation. Gold surges to $6,000, $7,000 as investors flee both stocks and bonds. This is the scenario that Paul Tudor Jones and other veterans fear, a repeat of the 1970s economic malaise where nothing works except hard assets. Scenario 3. Systemic crisis, 10% probability. Multiple shocks converge, a banking crisis in China, oil supply disruption from Middle East war, or a debt crisis in over-leveraged Western economies. Gold explodes past $10,000 as the entire financial system faces existential risk. Low probability, but not zero. And the consequences would be catastrophic. The bottom line, gold at $5,100 is not a random number. It's the market's way of pricing in fear. Fear of trade wars, fear of recession, fear of geopolitical collapse, and fear that central banks have lost control of the situation. Whether gold goes to $6,000 or pulls back to $4,500 in the short term doesn't matter as much as understanding why it surged in the first place. The global financial system is under more stress than any time since 2008. The difference is, this time, central banks have far fewer tools to fix the problem because interest rates are still relatively low, and government debt is at record levels. When the next crisis hits, and it will hit, policymakers won't have the same ammunition they had in 2008 or 2020, and that's why smart investors are buying gold now, while they still can, before everyone else realizes the same thing. The gold rush to $5,100 is just the beginning of a much larger story, a story about the end of an economic era and the beginning of something new. Whether that new era brings stability or chaos depends on decisions being made right now in Washington, Beijing, Moscow, and Tehran. One thing is certain, the investors who understand what gold is telling us right now will be the ones who preserve their wealth through whatever comes next. The ones who ignore the warning signs will learn the same painful lesson that every generation learns eventually, that paper promises are only as good as the trust that backs them. And right now, trust is breaking down faster than anyone wants to admit. What do you think? Is gold headed to $6,000, or is this just another speculative bubble? Drop your thoughts in the comments below. And if you found this analysis valuable, smash that subscribe button, because things are about to get a lot more interesting in 2026. This is Economy Elevation, and I'll see you in the next one.